The May 2026 CPI report dropped on June 10th. Inflation is now at 4.2%, the highest it has been in 3 years. My name is Theo and welcome to my podcast. I read every single line of this report so you do not have to. Here is what the numbers actually say, what they mean for your wallet, and whether anyone in Washington has a plan to fix any of this. Spoiler, they are waiting. Again. Before we get into the numbers, let's make sure we are actually on the same page. Because the moment most people hear the words Consumer Price Index, they check out completely. Do not do that. This report controls more of your financial life than almost anything else out there. So what is it? The Consumer Price Index, or CPI, is published by the U.S. Bureau of Labor Statistics. It measures the change in prices that consumers pay for goods and services. Everything: gas, groceries, rent, doctor visits, airline tickets, coffee. The Bureau of Labor Statistics tracks all of it, and once a month, they release a report that tells us how much more expensive your life just got. The report covers more than 90% of the total U.S. population, all urban consumers, professionals, the self-employed, the poor, the unemployed, retired people. If you live in a city or a suburb, this report is literally measuring your life. Now, here is the number you need to know before anything else. The Federal Reserve's official inflation target is 2% annually. That is their definition of stable prices. Everything above 2% is, by definition, a problem. We are currently at 4.2%. We are more than double the target. And here's the part that does not get talked about enough. The trailing 12-month average CPI over the past year was 2.8%. So we were already running above the 2% target on average, and May just blew past even that elevated number. This is not a one-month blip. This is a trend with momentum behind it. Let's go through exactly what the Bureau of Labor Statistics reported on June 10th. Headline CPI rose 0.5% month over month. That pushes the annual inflation rate to 4.2% year over year, the fastest pace since April 2023. And this is the second month in a row of accelerating inflation. April came in at 3.8%. May came in at 4.2%. That is not a coincidence. That is a pattern. Now here is where it starts getting interesting, and where the real debate between economists begins. Core CPI, which strips out food and energy prices, rose just 0.2% month over month, and 2.9% year over year. In fact, the monthly core number came in below the 0.3% estimate that economists had expected. That matters, and we are going to come back to it. There is a gap right now between headline CPI and core CPI of 130 basis points. Think of that as a 1.3 percentage point difference between what inflation looks like with energy included versus without it. That gap is the single most important number in this entire report, because it tells you exactly where the inflation is coming from. And right now, it is coming from almost entirely one place. Energy prices rose 3.9% in May alone. Over the past 12 months, energy is up 23.5%. Gasoline jumped 7% in a single month and is up 40.5% compared to a year ago. Let me just sit with that for a second. Gasoline cost 40.5% more than it did 12 months ago. Energy prices accounted for more than 60% of the entire monthly CPI increase. 60%. If you removed energy from this report entirely, May's inflation number would look completely different. Electricity prices rose 0.6% last month and are up 5.9% from a year ago. Even utility gas service, which actually fell 0.5% in May, is still up 3% year over year. None of this happened out of nowhere. Since the US-Iran conflict began, West Texas intermediate crude prices have surged more than 50%. The Strait of Hormuz, which is the narrow waterway through which 20% of the world's oil flows every single day, became a geopolitical pressure point almost overnight. And energy markets reacted exactly the way they always react to that kind of uncertainty. They priced in the worst case. But here is the part that goes beyond your gas bill, and this is important. 1/3 of the world's fertilizer supply is produced in the Persian Gulf region. 10% of global aluminum supply comes from the same area. Fertilizer feeds the crops that stock your grocery store. Aluminum goes into aircraft, soda cans, product packaging, and thousands of manufactured goods. The longer this conflict continues, the broader the inflationary pressure becomes. Because energy is not just what powers your car. It is an input cost for almost everything the economy makes. Energy is the big story. But several other categories in this report deserve your attention. Food at home, meaning your actual grocery bill, rose 2.7% from a year earlier. That sounds manageable until you look at specific items. Tomato prices surged 32%. Lettuce jumped almost 25%. Coffee prices rose 17.5% from a year earlier. These are not rounding errors. These are real increases on things every household buys every single week. For the month of May specifically, the overall food index increased 0.2%. Food at home rose 0.1%. Restaurants rose 0.3%. Those monthly numbers look contained. The annual numbers tell a very different story. Now let's talk about shelter. Because shelter is the category the Federal Reserve watches most closely, and it carries the most weight inside the index. Shelter costs rose 0.3% in May. That was actually half the gain from April, which is a positive sign. Annually, shelter is up 3.4%. And here is the critical context. Shelter makes up more than 1/3 of the CPI's total weighting. When shelter moves, everything moves with it. There is also an interesting wrinkle in the shelter numbers this month. Rent prices rose 0.4%, and part of that increase appears to be tied to a statistical issue. During the 2025 government shutdown, the Bureau of Labor Statistics could not collect rent data for October 2025. So they assumed zero rent growth for that month. That assumption is now unwinding, pushing the rent figures artificially higher. Essentially, a statistical ghost from last year's government shutdown is haunting the inflation numbers right now. Now for some actual good news. Core goods prices fell for the first time in 14 months. New vehicle prices, household furnishings, women's apparel all went down. Prescription drug prices also fell 0.9% for the month. Motor vehicle insurance declined 1.7%. New vehicles declined 0.3%. These are real offsets, and they suggest that the tariff-related price pressure that hit goods over the past year appears to be largely behind us. One category that went the other direction, airfares, up 2.7% for the month and up 27% year over year. If you are planning to travel this summer, you already know this. This is where it gets genuinely interesting, because the May CPI report is producing two completely different interpretations from serious, credentialed economists. And both sides are working from the exact same data. Camp 1 says, this is mostly an energy story, and energy stories can turn around fast. Heather Long, chief economist at Navy Federal Credit Union, said this: Americans are getting squeezed financially by inflation that's back at a 3-year high. The frustration for many Americans is that so many of the basics are up in price right now. Gas, food, electricity, and medical care are all clear pain points that are above 3% inflation. Ending the war in Iran will help to moderate inflation, but the worst is likely still to come for rising food prices. Angelo Korkafas, senior global strategist at Edward Jones, offered a more measured take. He said the CPI data gives the Fed, quote, some breathing room to remain patient as the energy supply shock plays out. If oil prices don't make another run higher, inflation will likely peak this quarter and begin easing in the back half of the year. Nancy Vandenhouten, lead U.S. economist at Oxford Economics, went even further. She said May could actually represent the 2026 peak for inflation, with easing possible before the year is out. Camp 2 says, this is worse than it looks, and the momentum is building. Ellen Zentner, chief economic strategist at Morgan Stanley Wealth Management, said, while today's numbers weren't as bad as some people feared, inflation remains well above target. With higher oil prices, AI-induced inflation, and tariffs driving up goods prices, the Fed will remain patiently on the sidelines. David Payne, staff economist at the Kiplinger Letter, warned that unless something changes in the Middle East, gasoline and fuel prices will keep rising, and food prices will follow, as fertilizer supply from the Persian Gulf gets disrupted further down the line. And Chris Rupke, chief economist at FWD Bonds, offered maybe the most direct political observation of the bunch. He said, Washington economic officials are going to redouble their efforts to tell Americans there isn't a cost of living crisis. The sky isn't falling after all, and the inflation risks for core consumer goods are in retreat for now. So where does that actually leave us? The optimists point to core CPI at 2.9%, contained, with core goods actually falling. The pessimists point to 2 straight months of headline acceleration and a geopolitical conflict with no clear resolution. Both camps are reading the same report. The difference is how much weight you put on energy and how long you think the Middle East situation continues. That 130 basis point spread between headline and core CPI is the number to watch. If that gap narrows because core starts rising, meaning inflation is genuinely spreading into wages, services, and shelter in a sustained way, that is the bad scenario. If it narrows because energy cools off as the conflict stabilizes, that is the best case for everyone. The Federal Reserve's current target range for the federal funds rate is 3.50 to 3.75%. It has been unchanged across multiple consecutive meetings. After the May CPI report, futures traders are now assigning a 96 to 98% probability to no rate change at the June 16th and 17th Fed meeting. That is about as certain as financial markets ever get about anything. The labor market is giving them no reason to act either. The May jobs report, released on June 5th, showed the economy added 172,000 jobs, beating expectations. The unemployment rate held at 4.3%. A strong labor market means consumers have income. Income means spending. Spending means inflation pressure. The Fed is watching all of it, and they are choosing to wait. Goldman Sachs economists revised their rate outlook on June 7th, just 3 days before the CPI report dropped. They now predict the final 2 rate reductions will happen in June and December of 2027, not 2026, 2027. And CME Group FedWatch data shows that futures traders are not pricing in any rate cuts at all in 2026. Here is why that matters for you specifically. The federal funds rate is the lever that controls borrowing costs across the entire economy. When it stays elevated, mortgages stay expensive. Car loans stay expensive. Credit card interest stays elevated. Business borrowing costs stay elevated. The Fed holding rates is not a neutral act. It is a deliberate choice that has real, direct consequences for real people every single month. Let's get specific about housing, because this is where most Americans feel inflation most personally. As of May 2026, the average 30-year fixed mortgage rate is hovering around 6.51%. The 10-year Treasury yield, which is the benchmark that mortgage rates track most closely, is sitting around 4.56%. A growing number of housing economists now believe the U.S. mortgage market is stuck. Their phrase for it is a stuck rate environment, meaning rates are not going meaningfully higher, but they are not going meaningfully lower either, not anytime soon. The reasons they cite: persistent service sector inflation, geopolitical risk keeping commodity prices elevated, structural housing supply constraints, and a Federal Reserve that appears willing to accept slightly above target inflation rather than risk triggering a recession. Selma Hepp, chief economist at Cotality, said it plainly. The lesson from this spring is that affordability gains are fragile. Rates can give back weeks of improvement in a matter of days if risk sentiment shifts. If the 10-year Treasury yield breaks back above 4.50% on a sustained basis, mortgage rates head straight back towards 6.75% or higher. That prices more buyers out of the market, slows home sales, and keeps the housing market frozen for longer. The 6% range, as housing economists are now calling it, may simply be the new normal for the next 12 to 24 months. Here is the actual timeline of what matters next. The June 16th and 17th Fed meeting is first. With a 96 to 98% probability of no rate change already priced in, the meeting itself is unlikely to be a surprise. What actually matters is the language the Fed uses, specifically, whether they drop any suggestion that rate cuts remain possible in 2026. The next CPI report is scheduled for July 14, 2026 at 8:30 a.m. Eastern Time. That report covers June data, and it will be the first reading that could potentially reflect any ceasefire progress in the Middle East, or any further escalation. It is the single most consequential data release of the summer for markets, mortgages, and Fed policy. Two scenarios from there. If the June CPI comes in below 4%, it supports the Oxford economics view that May was the inflation peak. Markets likely rally, Treasury yields ease. The conversation about rate cuts in late 2026 or early 2027 comes back to life. If the June CPI comes in above 4.2%, the Goldman Sachs timeline of no cuts until 2027 gets pushed even further out. And the conversation shifts from when do rates come down to something more uncomfortable. Could rates actually go up? There is one more thing to watch that most people are not paying attention to yet. 1/3 of the world's fertilizer supply comes from the Persian Gulf region. That disruption has not yet fully worked its way through to grocery store prices. David Payne at the Kiplinger Letter flagged this directly. Food prices will rise as those production and transportation costs pass through to the consumer. The gas price spike you are feeling today may be followed by a grocery price spike that arrives more slowly, but hits just as hard. Here is where things stand as of June 12, 2026. Headline inflation is at 4.2%, the highest in 3 years, driven almost entirely by energy costs that are up 23.5% year over year, and gasoline that is 40.5% more expensive than it was 12 months ago. Core inflation, at 2.9%, is more contained, and core goods prices actually fell for the first time in 14 months. That is a genuine, real positive signal. The Federal Reserve is holding rates at 3.50 to 3.75%, virtually no chance of a cut at the June meeting. Goldman Sachs does not expect cuts until mid-2027. And mortgage rates are stuck around 6.51%, with no clear path lower in the near term. Two questions will determine everything from here. How long does the Middle East conflict last? And does core inflation stay contained, or does it start catching up to headline? If energy cools and core holds, May was the peak, and the second half of 2026 brings gradual relief. If the conflict escalates and core starts rising, from food, fertilizer, and transportation costs spreading through the supply chain, then the worst is still ahead of us. The next CPI report drops July 14th. That is the number that tells us which story is actually true. I am Theo. I read the reports, I watch the data, and I will be back next week with everything that matters. Subscribe so you do not miss it.